Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to talk about a bunch of different, I'll say, investment outlooks. And maybe what the difference is between, say, someone like me investing and someone else who invests, and talking a little bit about time frames. Time frames are important because I can be bullish and bearish at the same time, given different time frames. What I try to do is I try to find the big long-term, not super long-term, but the bigger term cycles. Cycles being 5, 10, 15 years, 20 years in length, something on the lines of that. Then I invest for that time frame. And during that time frame, you're going to have sectors that are in favor and you're going to have sectors that are out of favor. So right now, for example, the sectors that I think are in favor are commodity sectors and precious metals over the next period of time. Now, the difficult thing that people have is that when someone's bullish, they think that the price just goes straight up. It doesn't work like that. It cycles up and down. It goes in waves. And it also can have pretty big drawdowns during a bull market. So what that means is, and especially if you're in smaller companies that are incredibly volatile, volatilities, it gets a lot of people because when someone's bullish, it means that the market's going to move upward, but it's going to grind upward in an up and down fashion. The pullbacks in some of these volatile companies are so great that some people avoid commodities altogether or commodity producing companies. The pullbacks can be 40, 50, 60, 70, 80%, depending on where you are in the bull market. Generally, when you're earlier in the bull market, you have larger drawdowns that you have to endure for the big move in the commodity bull market. I am going to go over some drawdowns in crude oil last bull market in the mid-2000s. I don't think the mid-2000s is going to be a great representative of what could potentially be coming because money is rotating at a greater rate, I think, this bull market that's coming than what it did in the mid-2000s. The mid-2000s was a mini bull market and never broke the interest rate downtrend line. We're breaking the downtrend line, which is much closer to, you could debate the 40s or the 70s, depending on what time frame and the market conditions that you're looking at. You could debate either one. And getting back to the time frames, though, I'm investing for the big bull market. So when I look at things, I look at a year or 2 or 3 out and I say, okay, what is the market going to look like 2, 3 years from now? That's the question I want to ask myself. And does the charts support that viewpoint? So it's not just me making up a viewpoint, investing off that viewpoint and not getting any sort of non-biased feedback to support either for or against that viewpoint that I create or that vision that I create of what I think the future may be. So we've seen a large underinvestment of oil. We've seen the markets tighten up. We're seeing inventories draw down. Basically, those are the indicators that I look at when I look for this stuff. And someone also asked about a false breakout. What's a false breakout? How do you know it's a false breakout? And really what that is, and I'll show you what one looks like here as well. It's when you've got structural fundamentals in place that cannot be solved on a short-term time frame. So think of underinvestment in oil, and we can't fix that in 1 or 2 or 3 years. It may take 5, 6, 7, 8, 9, 10 years, depending on what that deficit looks like, what market conditions are out there, what, is ESG preventing investments from flowing into it? Are politicians anti-oil, anti-drilling, anti-whatever? That can delay things. Are we going through a recession versus what we'll call more of a growth phase? If we're going through a recession, it delays it. It doesn't stop it. We need more supply to come on for us to fix the underlying structural shortage problem in the system. and that just takes time. So what happens is there's things that happen in the short term during the big, longer cycle that's needed to bring on more supply. So in the short term, we can have recessions, we can have news or events that happen, like the 2020 COVID event. We can have all these things that happen within the cycle that can bring it down. Now, those events generally are difficult to project. You know, I don't know if we're going to have one of those events 2 years from now or a year from now. Some people can claim that, but I don't know how they would know that before it happens. So those things are the short-term noise and volatility. The long-term, bigger picture view, when you look at all this, is a structural underinvestment in energy, which means energy prices go higher because of that structural underinvestment and because of the supply tightness and inventories drawing down from all of the commodities being short. You could also say that that is from credit expansion growth. That is why it's putting everything into a deficit. So it's a combination of those two things. But one can be bearish, one can be bullish on different time frames. And generally what happens is, at least from a commodity bull market, I can be a bull the entire thing. They'll say, oh, he's a perma bull. He's a bull, and he doesn't waver from his thing. It's like, well, yeah, because the supply problem hasn't been fixed. It's not, I'm not a bull to be a perma bull. I'm a bull because of the structural fundamental conditions that exist in the market. Now, in the short term, there are times I am bearish oil. I think it could go down in a short-term thing, and I will buy more. So when I look at this, I look at it to accumulate assets, to hold assets during this entire bull market. I'm not trying to trade in and out. I know there's a lot of people who are trying to trade in and out. I just make it easy and say, I'm going to stay long when the fundamental structural market conditions are not solved. I'm going to remain long. And when I get pullbacks, I'm going to buy more. I think it's the easiest way to make money with the least amount of stress, especially if you're playing with large amounts of money. You know, I'm not saying I have like copious amounts of money, but, you know, I don't know how traders, I mean, they're going to say, oh, I'm going to risk X amount of capital. I mean, do they put like millions of dollars in one shot? Probably not. But I mean, if you've got, you know, let's say someone has hundreds of millions or has a lot of money. I'm not saying I have hundreds of millions of dollars, guys. I'm just saying if someone has a lot of money, I don't know how you trade it in and out. I think they all kind of migrate towards the Buffett approach and then buy a lot of stock when it's cheap and then sell it when it's expensive and ride through the volatility in the short to intermediate term. That's the way that I have always looked at it and viewed it. So let's use this example on crude oil and show you what I mean. So in 1998-99, that's this period here, right at the end of 98-99, we got a buy signal in commodities versus stocks. And I'm using crude oil as the example here. That's what that big orange circle is. And if we kind of zoom way out, I think you can see it's a bull market that started here from that commodity to stock ratio. So we went long. Let's say you went long in this orange circle here. You went long, 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 long. And we went into the first pullback here. So we reached up to $37 and we had our first pullback. Everyone's like, oh, I'm going to time it. You should trade out of this. It's definitely, you know, sell out of all of this and all this stuff. So it went down about 50% on this pullback here, all the way from peak to bottom. This is a consolidation pattern. It broke to the downside for a little bit. In 2001, this was the recession or recessionary fears that were out in the market. And everyone would say, you know, oil's bad. So this is how the retail guys, oil's great. It's amazing. It's great. It's doing great. Oil's bad. It's horrible. Oh my God, how can I believe that this is so bad? And then you kind of look to the right and we're coming on up, and look what happened to oil. Yeah, we're coming on up. We had another sharp pullback here. But look what happened. Just keeps going higher and higher and higher and higher. Well, how does one know? You know, so how does one know? So number one, when we look at this, I'm just going to kind of delete all this stuff out of here. We traded on up. This here is the first leg. That's what the first wave or leg of the move. And we had the pullback, and this here is starting the third wave. And that's usually the largest wave. The size of this first wave can generally indicate how big the third wave could potentially be. Not with any sort of certainty, but we can kind of put this up here. And if this is the third wave, this is called a Fibonacci extension that I just put on here. So we look at it, and we can see that the third wave went between 1.618 and 2.618, and that's where it ended right there. So that's where it ended, was right between these two. And then we had another larger pullback. Now this pullback here, a lot of the times if we were to look at the cycles or waves, a lot of the times this pullback is like 50, 60%, depending on how big the move is upward and how big that fractal is. And then this one here is a little bit less. Generally, it's around 30-something%, like 32, 33%. This one's 37% or so. And this pullback here led to a fifth wave. So if we were to kind of looking at this, you'd say this is 1, 2 is the bottom, 3 is the big guy, 4 is the bottom of this guy down here, and then 5, and then the bull market is done. And getting the peak of this is going to be very difficult. We did have a ratio that was expensive, commodities to stock ratio in that orange circle. And you'd have been fine even selling out a little bit early on this. And then we went into a large consolidation period. So the bull market lasted from 1998 to 2008. And someone asked me, how do you know that you have a false breakout? How do you know that the market's going to continue higher? Well, number one, I did all this. I don't know with 100% certainty that we have a false breakout. But let's just say we have a cheap commodity to stock ratio. And let's say that you've got Elliott wave theory, that there's generally 3 big waves, up waves. And you've got 2 down waves. So let's say this is, generally speaking, wave number 1. We are going to get a pullback here. This went here, we were looking for a breakout, and it broke down to the downside. This is a false breakout, in my opinion. And the false breakout of that pattern right here led to a monster run, which, they asked me, what is a slingshot cheetah? What does that mean? That's what a slingshot is. The slingshot cheetah is when you break out of a pattern to the downside, and then it runs higher shortly thereafter. A lot of people probably got short here, and then it causes a gigantic surge of a movement. And the reason that I know, or think I know, I should say, that this is a false breakout is that you understand the ratios. You understand that this is a cheap ratio still. You understand that the markets move in 3 waves. And keep in mind here that you're going to also get 3 waves here as well. 1, 3rd, and a 5th wave. So you understand the markets to some degree, that they move in waves. You understand valuations, and you understand the market conditions that crude oil goes up in. During this time frame, we went up during an inflationary credit expansion phase of real estate. So inflation drives oil higher, more credit coming into the system. So the question here is, we started this bull market here. We went into an expansion phase of real estate. I should be long. You should be I should be buying these pullbacks all in here for this entire ride. And you want to accumulate kind of in this general vicinity down here for the bull market, because it has good risk reward. And you can obviously look at different sectors of crude oil, like energy service versus exploration production versus natural gas and oil and whatever else. So the way that you would know that this is a false breakout is because of the structural underlying fundamental conditions in the market. Was the credit expansion solved? And it was not solved in 2000 or 2001. The reason crude oil fell was from that recession. But people would not know how big that that drawdown would be. They wouldn't know how big this would pull back. There's a lot of unknowns. And obviously, when you're going through it, and what you see as a pattern that looks like this, you're like, oh, that's a continuation pattern, and it breaks to the downside. People are going to get all afraid. They're going to say, oh, crap, that's the bull market's not going to exist. And then it reverses and moves on up. That's your false breakout. That's the emotional kind of how they validate their opinions on the market. They just use price. They say, oh, the price is going down, it's bad. Price going up, oh, it's good. But I don't look at that. Price is a function of the market conditions that are existing in the markets. So price during this was recession driven in the short term. But in the long term, we had a structural, fundamental credit growth in the expansionary phase of real estate that drove that price move in commodities in the mid 2000s. I mean, yeah, commodities, obviously, people were buying more commodities, and that is a function of increasing interest rate environment and people unwilling, or countries unwilling, to dump money back into bonds. So they're more than likely going to buy more commodities during those timeframes. So the market conditions influences humans and how they interact with each other based off those market conditions. But that's how I'm doing it. I'm not looking at price and price only and saying, oh, price is going up, it's good. Price going down is bad. And what happens is people confuse things. They'll say interest rates are going up, therefore, I'm not going to be long oil. But if someone rode this all the way up or got real close, maybe they sold out here, or maybe they sold out on the way back down, they still won massively. And they didn't have to trade in and out. They didn't have to trade, this little pullback and this little pullback and that little pullback. I mean, you're going to go crazy trading all this. It's very hard to do that. So I just take the big picture view. I use my ratios and I use the structural fundamentals to shape my viewpoint of if I should be long or if I should be out of that particular stock. Now, this is a big consolidation period. This is driven by real estate, in my opinion. This is the big consolidation period here. And we shouldn't be in oil at that time. But in 2000, they were talking about a false breakout. This is a false breakout to the downside and then a slingshot higher. You can see the slingshot higher. And now we're getting our first pullback. So when you hear me talk about what's coming, so in my opinion, this here is wave 1, and we're making a wave 2 pullback. This is your false breakout at the beginning of the bull market. And this is your slingshot cheetah, where it slings it all the way back and flings it on higher into a large uptrend move. But we had our first pullback here, right? We had increasing interest rates. The market slowed down. The market did bring oil back down with it. And I do think that oil is eventually going to move to the upside and I'll say go up again in a wave 3 movement, which is the longest, biggest wave of all of them. So if we look at the last one, this is wave 1. This is wave 3. And then we had a blow off wave number 5. And then we went into a large consolidation phase. So 1, 3, and 5. And what I did is I bought pretty close to the bottom in here of a lot of producing companies. And I've been riding it the entire time. And yes, I've been riding it through here. The only time I will sell out of anything is if I think there's a better opportunity with better risk reward in another investment. And I have skimmed off the top of some of my investments and put it into what I think are better risk reward opportunities. I've done that a few times. And I think wave 3 is coming. We have the market conditions that are still favorable for oil to go higher. We've got massive inventory drawdowns on oil. And I hate to say it, but this here was driven by credit and credit only. This was not driven by inventory going massively lower. And this, the power and the potential of this bull market over here is vastly greater, like way greater than the mid 2000s. It's more like the 1970s in terms of how powerful this bull market can be. And the reason I say that is because of the interest rates breaking that 40-year downtrend line. That 40-year downtrend line. So That's the 40-year downtrend line. And during that last bull market, we did not break that downtrend line. From, 1998 was here. So we went up, we came back, and then we went up again. And this was in a falling interest rate environment. We have now broken that 40-year downtrend, and we are in an increasing interest rate environment. That's a totally new regime that we haven't seen since the 40s, 50s, 60s, 70s. And it eventually peaked in 1980. This is the peak right there in 81 for interest rates. So when I see this and I say, wow, this could be one of the largest kind of bull markets that we could potentially see. I like this inverted head and shoulder, guys. I like that guy there. But this could be one of the larger bull markets that we see in anyone's lifetime that's living, at least. I mean, maybe some people saw the ones in the 70s as well. They're getting older. But ones that are in working age, this is a little bit different market condition. Money's rotating out of bonds, and it's going to go find a new home somewhere else. And it's a lot of money. It's not just a little bit. It's a lot. This is a end of trend movement. So, I look at crude oil. I think there's a lot of potential there. And that is what I'm looking at. I'm looking at the structural fundamental conditions where this has to go higher with time. In the short term, we could have a recession. We could have slowdowns. We could have all sorts of stuff in the short term. We could have lockdowns. We could have China on COVID lockdowns. We could do other things. It's all short term. It's not fixing the supply problem. And that's where this here is where I think we're, somewhere here, and maybe we're at the bottom here and about to go higher for oil. And that's literally how I do this. That's because someone was asking me, how do you know it's a false breakdown? Well, it's based off of the ratios. It's based off of the market conditions. It's based off the structural fundamental problems in the market. It's based off of inventory levels and how the inventory levels are dropping down. It's based off all that stuff. And that's why I continue to buy into it. Now, if we get a pullback and my favorite stocks go down, if you're a buyer, that's good. They're getting cheaper. If it's just going to go straight higher, I mean, nothing goes in a straight line. I'll just say that. Nothing goes in a straight line. You're going to get many 50% pullbacks. And if you don't know what this bull market is, if you don't take a viewpoint like I'm viewing it, you're just going to get chewed up and spit out. That's really what's going to happen. You're not going to be able to hold on. You're going to get afraid. The emotions are going to get the better of you, and it's going to spit you out. Now, is there times where you could trade in and out? I mean, there maybe could be, but coming past this first point, I'm going to say that the drawdowns get a little bit less. They're not going to be as big at some point here. And when we break to the third wave, the drawdowns in that third wave, I don't think will be as big. We'll have one last, maybe bigger drawdown because, again, the third wave is going to have 3 legs in that one too. And the first drawdown is generally the biggest one. So we come on up and then we get another big drawdown and then we start to really take off. So I just sit in it, and there's nothing really to it, guys. Structurally underinvested, have problems. I just sit in it. It's that easy. And then I wait a long time. I look at this, I look at the waves, I say, okay, wave 1's about done. We're probably going to get pulled back. And I'm not going to get everything right. No one is. And then all these other people, they're going to try to predict the short-term timing. They could be right. They could be wrong. They're going to tell me I'm right or wrong. And that's just the way it is. I play the big picture view here, and I think the third leg's coming at some point here shortly, and that's going to impact all of the commodities, and they're going to have big old moves, very big moves. The third leg's the biggest leg, and it's going to blow people away. They're not ready for this, and neither are the companies and all these other areas. So we're in the middle of this cycle. I think I don't know how much longer we got, maybe 3, 4, 5, 6 years left. Something on the lines of that, maybe 7 at most. And we'll see where we go. I don't know the future. I don't claim to know the future, but I mean, looking at the last cycle, you kind of know what's going on now, right? You kind of know where we are at. And it lines up very well with where we're at in the expansionary phase of real estate. Now, a lot of people think that they can stop this move in real estate. I don't know if they can. That is not a fact. Interest rates did not stop the moves in the 1970s of the baby boomers buying homes. It slowed it down maybe, but it didn't stop it. So we'll see. We'll see. I don't know. I don't have the answer. I'm not saying that it can't stop it. What I'm saying is the people who think that the Federal Reserve has more control than what they actually do is what I think is my stance, is where I don't think they control everything. They can control some things. They can slow it down. I don't know if they can stop it. It's driven by structural fundamentals of the demographics coming up. And what people are going to have to do is they're going to have to save more money to put a down payment. And when prices start to fall back down, people just buy it up again. So it's a difficult thing to solve when it's driven by demographics coming into home buying age. So either way, we'll see how it plays out. I mean, obviously, you can join the channel here. We can watch this all together. And you can obviously join the finding-value.com, the Platinum membership, if you have further interest in finding out how these commodity bull markets work. We go over a lot of the stuff I just went over today. We look at individual companies as well, and I show you last bull market similarities of the bottoming of patterns and what we have today. And really why I do all of this is to get people confident in it, because the charts are an unbiased way of looking at things. And I'm the one trying to translate it to some degree and put my viewpoints around it and my opinions around what potentially is happening. So that's what I've got for today, guys. Hopefully you enjoyed it. Give me a thumbs up. Subscribe to the channel if you haven't already, and we'll catch you next time. This is Finding Value.